Hello, everyone. Good morning and welcome to Weekly Profit Talk. Every single week, we sit down and we talk about the things that profit your private physician practice. We also have tips that carry over into other entrepreneurial endeavors. So, even if you're not a doctor, if you've got 10 minutes, you'd like to spend a little bit of time learning how I save doctors money, it might apply to your situation as well. So, hang out because this week's topic is your practice's end of year tax physical. So, um, every single Wednesday, we do sit down. We do this at 8:30 a.m. Mountain Time. That is 7:30 on the Pacific Coast, 10:30 on the East Coast. With that out of the way, the topic is your practices end of your tax physical. Let's go ahead and we'll bring up the handy dandy guides and talk about cash flow. So, first thing, um, in the typical physician practice, claims receivables are just basically a fact of life. If you're able to actually get paid within 53 days, um, I believe that that's kind of a golden number. So, uh, that aging report that you have is just like a patient's chart, as I wrote down here. If you've got stuff sitting over 60 days, 90, or even 120 days, which is seriously aging, um, you're basically hemorrhaging cash. Pull in your aging receivables report. Any reasonable accounting software or bookkeeping software has that. You should have accounts receivable aging or aging report, and it will list things by the date. Everything that you've got over 60 days needs a follow-up call, and anything over 90 days, you need to turn that over to the people that are able to actually get that money into your practice and get it there by the 31st of December. Now, why is this important? Simply put, the money that you record and report in 2025 is basically going to be what you're paying tax on, and tax season come up in the next few months. Chances are, if your business is scaling, it's pretty good chance that you don't want to carry forward 2025 revenue into the new year, where it can actually expand your growing practice even further and give you an even higher tax burden for next year. So, this is a very good thing to be addressing right now. So, patient responsibility collection strategy. This is always fun. Now, I've gotten used to the idea when I go to see a doctor, and I'm of that age where I've got Medicare Part B, so I'm kind of been asked for my insurance stuff. If there's co-pays or co-insurance, they have that calculated. Um, they'll basically let me know up front that this is the part that we know that insurance isn't going to cover. So they bill for it on the spot. If you've been nice and letting that go, the time to stop doing that is yesterday. So patient balances are the silent killer of your cash flow. Now, co-pays, of course, obviously, you're going to collect those at the time of service. That's the whole definition of a co-pay. But again, if you let that co-insurance float into future accounting cycles, which is just basically a long phrase for months, then you're basically reporting your revenue in a different time period and not matching it to the time when you're actually providing the service. But the other thing is, it's another money hemorrhage. So collecting at the time of service is critical. And if you're billing software, your patient interaction software already knows how much that amount's going to be, don't be afraid to ask for it. Basically, you went to school for and did residencies for 10 years or more, learn how to do this. You're worth what people pay you. So they're not guesses, they're revenue protection. I like that, so I wrote it down. December is your last chance to recover 2025 revenue that is technically yours already. My golly. So the deduction vitals check. Now, this is something I want to touch base on because we've had some shakeup in our federal government this year. I know everybody might still be feeling the sting of the government shutdown. Certainly, it's affected a lot of people's lives, but even before that, Congress basically pushed through a lot of tax changes. One thing that is actually helpful to people that are running their own businesses, like you and me, is that bonus depreciation is back. It's back at 100%, and it's going to hang around for a while. I believe actually the last year for it's 2029. And by then, of course, Congress changes every 2 years, all of the House Representatives and one-third of the Senate. So who knows what they're going to do after 2028, right? So, or excuse me, 26 even. Beg your pardon. So I'm good with numbers. This is why I do this. So, all kidding aside, that diagnostic equipment that you might have been lusting after, been outsourcing people for X-rays or even MRIs, if it's something that you basically have to do extensively. Um, if you're income qualified, you can write off over $1 million in equipment purchases in the year of the purchase. Now, you may or may not want to do that. First of all, most equipment has a 5-year depreciable life. So you'd be writing off one-fifth of it in the first year because of half-year convention. And then you're writing off 40% of the remainder in the following year. So that way you're writing off more in the first couple, 3 years, and then less as time goes on as the asset is worth less. So that's called double declining balance. And that's worthwhile because you're basically writing off an expense for several years on a piece of equipment that you'll be using for those years. But what if you've had an amazing year and you're going a little cross-eyed, realize that you're going to be owing thousands and thousands of dollars in extra tax, um, writing off something that cost your practice $250,000 all at once would reduce your net income by $250,000, and that's going to have a huge effect on your final tax, especially if you're an S corporation where everything flows through to your 1040 from your K1. So you may or may not want to take advantage of that. And there are two different ways to write something off all in the same year. Section 179 is one of them, which allows you to write off a piece of equipment if your income is under a certain level and the total amount of the write-offs. And also, as long as that write-off doesn't send you into a net operating loss. But if that's going to be the case, it's kind of counterintuitive anyway, correct? If a large write-off is going to send you in a net operating loss, then you're going to want to use double declining balance anyway and take advantage of the future expensing. Okay, hopefully I'm making some sense here. So, but you have options. If 179 doesn't work, bonus depreciation is also there for you. So, a couple other things. Uh, well, big thing here is if you have a 401k and that's set up so that you're able to make 25% of your reasonable compensations wage level in contributions, have you done that yet? Because if you haven't and the money's there, that's a huge write-off for you as well. That will basically reduce your net income, and that's going toward your retirement. And if you have that in an instrument it's going to typically have 9 to 12% return on investment a year, like a good index fund, for example. Then it's just a classic win-win-win situation. So give that a lot of thought. You've got 3 weeks. Okay, today's the 10th already. Strategic expense timing. A lot is made of this. You'll see this on social media. It's like, well, now's the time to buy something expensive, and get your net income down. Well, sure, as long as that expense is useful. Because one thing you want to keep in mind, and this is super important, is that let's say you write off something that's worth 10,000 bucks. Okay. And again, that's a depreciable asset. So let me come down to earth a little bit and we'll knock that down to $1,000. Now that would actually be an expense, something you write off in the same year that you incur it. Okay. Malpractice insurance, that's a biggie. But some of the other things, your office lease, for example. If your landlord is accustomed to getting your money around the end of the month, I would absolutely make sure that that check clears by the 31st of December, or you're able to report that expense in December because you definitely want your lease expense to all be in matching your revenue for the year. So that's super important as well. But I was getting back to a larger point. I want to share this with you. It's one of the last things before we wrap up here is that you write off $1,000. Okay, so you're reducing your taxable income by $1,000. Now, let's say, as a doctor, after taking all the deductions you possibly can, you have an effective tax rate of 20%, which means you're basically paying um, so much tax, which is 20% of your taxable income. Effective tax rate is simply a percentage. You divide your taxable income into the amount of tax it's calculated on IRS tables. The good software does all this for you, but if your effective tax rate's 20%, then a $1,000 write-off basically nets you $200. You understand how that works? That's like when people take some folks out, it's like, well, we talk about business for a few minutes. You can write this off as a business meal. I'll sit still for that, but understand something. You're only writing off the effective tax rate, and on meals is a 50% write-off. Actually, half of that is non-deductible. So if you spend $100 on you and your friends, and you're actually going to get $10 of that back at the 20% effective tax rate. So keep that in mind next time your largesse kicks in. So, okay, you're still going to pay for 90% of that meal yourself. Uh, Keeping in mind the following to wrap up, pass-through entity taxation structures. If you're an S corporation, that's what we're talking about. You're basically taxed as a corporation, but your profit flows through to your Form 1040, and that's in the percentages of ownership. Um, uh, Most of my doctors are 100% owners, or they're 50-50 with their spouse, that sort of thing. So that passes through in the proportion of your ownership. And knowing that S corporation actually saves you money on FICA tax. If your practice is making over, and I'm going to say a nice comfortable number of 70 to 75K for the first time this year, you can actually go back and do what's known as a late election and elect S corporation for your business for the entire year of 2025. If you have any questions about how to do that, this is what we do all the time, and I'd like to wrap up on that. Um, I wrote down a couple other things too. Qualified business income deductions. Uh, Keep in mind, as long as you're under a certain level, even as a doctor, if you're under, and the number changes every year for inflation adjustment, but married filing joint, as long as you make under 400,000 net uh, or adjusted gross income, you are able to write off 20% of your business uh, income as an additional deduction, which is added to the standard or itemized deduction that you take. It's the line right under it on your 1040. So, and retirement contribution limits. Keep those in mind. If you haven't contributed fully, um, December is kind of a interesting time to do that because the market tends to have an upswing, but at the same time, you can basically count on over a period of many years the market increasing because we have lived in inflationary times basically since Abraham Lincoln. So uh, investment is never a bad idea, even if, like me, you're over 60. So um, let me leave you with this thought. If you are in that 70 to 75K bracket and you're wondering how S Corp can save you money, I my quick answer is I can put $7,000 to $8,000 of unnecessary tax back in your pocket this year. If you'd like to know how, I'm coming to you live, or you may be watching this in replay in one of three different ways. You may be viewing this on YouTube or LinkedIn, as well as Facebook, and they all three have in common a comments capability. Write S Corp or help or more information into those comments. We'll answer you within 24 business hours, and let's talk because tax season's coming, and I can put thousands of dollars back in your pocket and enjoy every minute of it because we love doing this for people. So, with that, let me wrap up for this week. Hope you're having an amazing day today so far, and your holiday season's merry and bright. We've got 15 days to go. So, with that, have an amazing day. And if you have a chance, do something randomly kind for a stranger today. So, until then, so long, and have a great rest of your week.